The topic of this video blog is socially responsible investing, SRI options. So aligning your financial goals with environmental, social governance impact. So the key approaches, the key strategies for socially responsible investing are screening, shareholder advocacy, and community investing. Those are the three approaches. Screening just means including companies or excluding companies depending on their environmental, social governance practices. It could be also just the industry they're involved with that you'd want to avoid. Screening doesn't make much of an impact. It more just allows you to avoid irresponsible or harmful industries and get them out of your portfolio, especially if you think they're not going to have a good future in the long run. They're just out of your portfolio. But as far as making an impact on the companies, that's where shareholder advocacy comes in. As a shareholder, you can vote on shareholder resolutions. You can bring up shareholder resolutions. You can interact with companies. Or if you own a fund or have someone else managing it that is engaging, you can, or they will on your behalf, engage with companies to make positive changes. And they work on a whole wide variety of issues. It can be on political contributions, on greenhouse gas emissions, supply chain conditions, executive compensation, diversity on boards of directors. There's a lot of things they're voting for or bringing up or engaging with companies around. And this is where you can make a real impact. And there are different types of funds. Some funds will do a lot of screening and only hold responsible companies, and some will hold a big, broad swath or the entire market or a portion of the entire market and engage with companies that aren't deemed responsible or industries that aren't deemed responsible. Just to try to make an impact, not only on responsible companies, but on all types of companies. And we classify them as base engagement, the different funds, the different investments, as funds that are doing some base engagement. They might be doing no engagement or very minimal engagement, but generally, if they're SRI funds, they're doing base engagement or deep engagement. And of course, deep engagement, they're doing more interaction. They have dedicated staff usually that are engaging with companies to make changes. Sometimes they're focused on a certain issue. Sometimes it's pretty broad what they're engaging on, just environmental, social, and governance issues. And then community investing is the third pillar or the third strategy with socially responsible investing. It's lending to underserved either people or organizations to support affordable housing, local businesses, and foster economic growth. So examples, well, we'll get into examples. We use a tool called Your Stake. It's for advisors, and it does allow you to determine or gauge the amount of screening your funds are doing, the amount of engagement they have. You can screen your investments based on base and deep engagement. So if you say, I want funds that are really trying to make changes, then you can just look for funds that are deep engagement, look at their performance, look at their holdings, look at their expense ratio, the cost of operating that fund, but it helps the investor choose funds based on that engagement level, based on the issues you care about. There could be some issues that you want to screen around and not hold. If you're a nonprofit and you're investing for Mothers Against Drunk Drivers, you might not want to have a lot of alcohol in your portfolio. And that's just on principle, not based on performance or based on other criteria. Just certain organizations may not, or religions or groups or people might not want to hold fossil fuel companies or hold certain handgun manufacturers or different industries. They just might not want to hold, and that would be part of it. We can show with the software within the funds, what do you hold, actually hold, and what is triggering an issue around, yeah, in the environment or detention centers or the for-profit detention centers, a lot of different issues it can screen for. It simplifies the process so that you can customize those portfolios for people. Okay. Screening versus engagement. So some funds, I mentioned this, some funds are screening and avoiding irresponsible companies. They may exclude fossil fuels, tobacco, weapons. And examples would be Green Century. They're a nonprofit fund manager. Their focus is the environment. They do not hold fossil fuel companies in their portfolio. Nuveen Emerging Market is another example of this. Some funds are looking to engage and they may have less responsible. Some funds look for the best in class. So we're going to have fossil fuels, but we'll have natural gas, or we'll have the most responsible of the different sectors. But they're going to engage with them. And then some funds like Vote, this is engine number one, they are focused on the environment. They do not screen at all. They hold the S&P 500 and they are trying to engage across their big goals are engage across agriculture, transportation, and fossil fuels. So they hold them in their portfolio so that they're active participants. If you don't hold ExxonMobil, you don't get to vote on any of the shareholder resolutions for ExxonMobil. So they actually got 3 environmentalists put on the board of directors of ExxonMobil. Was one of their more famous achievements. And they engage with other companies on other issues. All of these funds are engaging. So they are, yes, engaging them to improve their environmental, social, and governance practices. So those are the 2 big differences. Screening and advocacy, there is a cost to it, but over time, as funds have grown, there's been a good amount of demand for socially responsible funds. The costs have come down. The expense ratio on Vote is 0.03, 0.03%, pretty small expense for the fund. The expense ratio on USSG is 0.05%. A lot of them are in the 0.1% range. So it may be a bit more than an iShares or a Vanguard S&P index, but for 0.03%, you are engaging with companies to try to make positive changes. And it's not that Vanguard or iShares or Schwab funds are free. They have an expense ratio, and usually it is a 3 to 0.05%. Even the big, massive funds, index funds. So the way to get into these socially responsible investments are primarily through exchange traded funds and mutual funds. So that's one fund, one ticker, and it holds a whole bunch of stocks, or it holds a whole bunch of bonds, or it holds a mix of stocks and bonds, but it's through a fund, and the fund is engaging on your behalf. So not all funds are equals. There are sites like USSIF, USSIF, that tells you about some SRI funds. It's a pretty good site. It's free. And but you can see there's some funds, I believe Ariel, that they screen out nuclear and handguns, but don't engage with anyone else. They don't engage with companies. They just have a couple filters and that's it. Maybe that's what you want. Great. But just know what you're getting into. Are you getting into a fund that is engaging? If your big issue is the environment, great. Are you in a fund that's going to engage on environmental issues? If you're more broad and you want and you care about supply chain and political contributions and all these other issues, do you have a fund that's engaging on a bunch of different issues and voting? The shareholder resolution or the proxy votes that they're voting, or that they're putting forward their own shareholder resolutions. That's a site like your stake that they can give you more information about the level of engagement because some funds are called SRI, but they're a Vanguard or an iShares fund that really isn't voting or engaging. They just do some minimal filtering. So even when you look at the holdings, you want to be sure, is it a fund? We had a prospect recently was saying she looked through the holdings of some of these SRI funds and they didn't look very SRI. And the screening is different for different funds. Some funds will do extensive screening. They'll only hold 30 holdings. Well, is that what you want? Do you want 30 holdings of US large companies, or you probably want to make your portfolio diversified and have foreign, small, mid, large cap growth, large cap value. You want to have bonds, possibly, you know, different types of holdings, diversified holdings to build a full portfolio. Do you want them all to be SRI? Do you want just the large US ones to be SRI? There's lots of options these days. So you could build a totally SRI portfolio out of exchange traded funds, which just are following indexes. And you can build it out of funds that have deep engagement or just base light engagement. Or no engagement, just doing some screening. So there's a lot of options in that world, and you are participating in engagement if you're in funds, exchange traded or mutual funds, that are engaging on your behalf the way you want them to. Another way to do it is individual stocks, individual bonds. You can totally filter how you want to invest. You can hold the companies you want in an account or in multiple accounts. The engagement, you can pay to have engagement done. There are services to do engagement on your behalf. Mostly they're marketed to advisors, that you'd go to an advisor, they'd pay for engagement on your behalf, and then they'd screen the individual holdings as you want them to be. But that's individual stocks and bonds. And mostly the engagement will not be generating shareholder resolutions. It will be just voting on the resolutions that come in. So doing proxy voting. Community investing. Now this is lending. I think in underserved communities, one part of community investing is just not using big global banks, using a credit union. Another is there are, like Calvert has social impact notes. There are quite a few impact notes where you're lending. It kind of works like a CD where you lend for a certain amount of time, you get a certain amount of interest. At maturity, you get your money back. They have different risks, different amount of loan loss reserve. So you want to make sure it's the amount you're putting into those is an amount you're comfortable with given the risk of that holding. There are microcredit organizations you can lend to. There are other organizations, but usually it's to a fund that that will have a diversified portfolio. And then the fourth option, and these are not exclusive. You could have a separately managed account and have a ETF portfolio in another account, or you can have some community investments and have a separately managed account. But a separately managed account would be through an organization or through an advisor that handles that, but you'd have it set up. Usually they're going to do individual stocks and they'll engage on your behalf. You usually are doing a SRI questionnaire. What issues are important to you? How much is cost or expense important to you versus engagement? And there's a variety of, sometimes they do have a mix. They'll have some funds. I know First Affirmative usually uses bond funds, but then uses individual stocks. So it may be a mix, but that's another way to do it. Here's some ETFs. So we talked about this Vote, the engine number one, who they're focusing on shareholder advocacy. They're not doing any screening and corporate governance, but they're really working on the environment is one of their big issues. USSG is a high environmental social governance score. They do some screening, but they do quite a bit of engagement. And then Green Century, again, just examples. There's hundreds of funds out there. These are just three. Green Century, they are working towards the environment, sustainability. They're a nonprofit and they have mutual funds, where the other two are exchange traded funds. Okay, those are just three of many, many options. Community investing and separate managed accounts. So in community investing, you can do community development financial institutions. There's a lot of credit unions, some community investment banks or Aspiration Bank. And then I talked about the Calvert Impact funds that can be held right at Schwab, just like a CD. You can hold them to maturity and they'll pay an interest as you hold them. Okay, separately managed accounts. Here's a few examples of separately managed accounts. First Affirmative is one place. You have to work through an advisor. Actually, we're advisors with First Affirmative. Open Invest, Trillium Boston Common. Some of them have very high minimums. So if you have $500,000 or $1 million, sometimes the minimums are quite high to have them do a separately managed account. And again, it doesn't have to be all or nothing. You can, if you have quite a bit of assets, you could do some in a fund. First Affirmative, actually, their minimum is 25,000. So you could do a First Affirmative account. It's kind of, I think of it as a customized fund because you can pick out exactly what you want. It's nice for capital gain or capital loss harvesting. If you want to take some losses by the end of the year, you have a lot of control with the individual stocks. But yeah, the big disadvantage is the minimums are high. And then choosing the right strategy, it's everyone should do what they're comfortable with. If it's just moving from a Bank of America or Wells Fargo to a local credit union, great. That's fabulous. If it's using some SRI funds in your mix, great. That's wonderful. If it's at your 401k, just requesting, saying, hey, could we have a couple SRI options? That would be fabulous. Yeah, I mean, request it. Make people know that there's a demand for this. There should be SRI options in your 401ks. Usually we see no SRI options or one or two with high expenses. It's not much of a variety usually, but they're not going to make a change unless people request it. So choosing the right strategy could be using some ETFs. It could be using individual stocks. If you want total control, you can do the proxy voting, or you can have your advisor do the proxy voting, or you could have, their services, they'll do the proxy voting. It depends on how much you have that you want to invest and how much energy you want to put into it. If you just want to have a fund company do it for you, just select the right company that's going to engage on issues you care about. And that can be a fine way to do it. And then separately managed accounts are really, because of the real high minimums, well, again, First Affirmative has a pretty low minimum, 25,000. Most of them have really high minimums, but that can be a limitation on the separately managed accounts. Okay, conclusion, SRI empowers individuals, create a financial portfolio that aligns with your values. We've had clients come in and say, I don't want to be in the stock market at all because it just seems like a money grabbing, destroy the world environment. And I'd encourage people to do more research about it because there are responsible funds trying to make positive impacts. And it's a big variety of options out there. And if you pick the right blends of SRI options, you can contribute positively and achieve your financial goals. There's been studies showing that you're not sacrificing returns by including environmental social governance to your decision making. That's it. Let me know if you have any questions. I'm Bill Holiday, CFP with AIO Financial, aiofinancial.com. You could find out more information. We do specialize in clients interested in socially responsible investing or sustainable, responsible impact investing, or ESG, environmental, social governance investing. Let me know if you have any questions. Let me know if you have a different topic you want me to discuss about this, or if anything I covered was confusing. We offer a free upfront meeting right on our website, and we'd be glad to talk about your financial situation and our services. Also, this is not financial advice. We are just providing information. Okay, you definitely read the prospectus, discuss this with your advisor. Yeah, these tickers I was discussing are just examples. We're not saying everyone should, this is appropriate for everyone's portfolio. Okay, great. Thank you. Thank you for watching. Take care. Bye.